Alright guys, welcome to another video. Today's video we're going to be talking about how to improve your trading performance. Before we get started, everything in this video is just my opinions. They are some suggestions for you, however you can take them for what they are. There are no trade recommendations here. Having said that, there are also no pretty charts, no strategies, no Lamborghinis or large stacks of money. So hopefully you get value from this and you don't click away, since there's none of that vanity stuff. Anyway, yeah, also before we get started, please subscribe and hit the alert little bell icon so you get notified when new videos come up. Hopefully this is just the first of many videos, so make sure you subscribe for more content. Have you ever looked at your P&L for the week or for the month and cringed? And you asked yourself, what happened, or how can I improve? Have you asked anyone else, any other traders, how you can improve? Well, I used to ask myself a lot, and I think a big part of it is like yourself. So I have these questions for you, and if you can answer these ones, that's great. At least you kind of have an idea of what to look for. So please feel free to comment below your answers for these questions if you like. It would be interesting to see if people know what we're talking about and are able to measure themselves. Question 1. What's your expectancy per ticks or dollars, I guess, in per contract? We're also going to look at your profit factor. We're going to talk about your main trading errors. Everyone's has trading errors. No one's perfect. We're going to talk about risk. How much are you risking per trade in terms of a percentage of your trading capital? How would you describe your trading edge? Do you even have a trading edge? What's a trading edge? And lastly, do you have a well-defined trading plan? That's a great one. Everyone's heard that one before. Okay, expectancy. So expectancy identifies the amount of ticks or dollars your trading performance is expected to produce per trade. This can be measured by tick units or tick value. It can be measured across different type of issues that you're trading. So if you're trading futures, like I do, this could be measured by tick or your tick value. Say for example in the E-mini futures, 1 tick equals $12.50 in tick value. If you're trading crude, 1 tick is equal to $10. I prefer to use ticks because a tick is a tick is a tick. Even in stocks, a tick could be 1 cent. So I think that's the best way of measuring it, but some people like to see it in dollars, which is fine too. You just need to do a little bit of different calculation. But ultimately, expectancy is a number that measures, how much you're expected to produce per trade, per contract, per stock, per unit. Sample size should be significant, at least 30 completed trades. So you don't want to be looking at your expectancy when you only have like 2 trades and your expectancy is like 6 ticks per trade per contract. That's pretty good. However, if you only have 2 trades, then that's really small sample size. So I think you should have at least significant expectancy should be at least 30 trades, and of course the higher number of trades you get later on as you continue to track, your expectancy moves less significantly depending on how many trades you have. It is an important measure to understand if your trade sample is producing actually an edge. So it's a really good way to understand, hey, like what's expected to be gained or lost every time I make a trade. Every time you click that buy or sell button, what is your expected P&L, so to speak. So if you know your expectancy, comment what your expectancy is below. I'd like to know if you even track, and if you do, then what is your expectancy? Okay, next, profit factor. The profit factor measures the average of all your winners against the average of all your losing trades. So pretty much it's measured as a ratio. You should have a significant sample size, and just like expectancy, you should have around 30 trades or more before you can get a better assessment of what your profit factor is and whether in the long run it's showing an edge. So it is an important measure to understand to see if your trades are producing a positive risk to reward. So for example, if the average of all your winners is 1.5 times your greater than the average of all your losers, then your ratio is 1.5. So basically a ratio of 1 is break even, right? So the average winners is equal to your average losers, which is a ratio of 1. Means that you're breaking even, or your trades altogether are breaking even. So it's really an important ratio to understand, because you want to make sure that you're not taking more risk than you're getting out of the trade, and over time, if you keep doing that, that's going to drop your profit factor ratio. And if you're below 1, which I think a lot of struggling traders may be under 1, because they're holding on to their losers longer and not letting their winners run. So for example, like you get a trade 10 ticks in and you're like, oh, that's enough, or 3 ticks in and you're scared and you take the 3 ticks, but when you lose, you're losing, say, an average, for example, like 10 ticks. So averaged out, your losers is, say, around 10 ticks, and your average winners is 3, then you're like at 0.3 profit factor, which is pretty bad. And again, over the long run, as you build like a larger sample size or trade samples, then your P&L is not going to be positive. Trading errors. Eliminating your trading errors will drastically improve your trading performance. Yeah, that sounds pretty logical, but I think this one requires traders to be really honest with themselves, and that's not always easy. You need to come up with a list of trading errors and assign a number to them. Assess the trade prior to entry, then again at exit for errors. If you made any errors, you need to track them, and also you need to track the cost of those errors. Often, yeah, you can say you made an error, but when you really put a cost dollar value beside each errors and then you tally them up at the end of a period, you can really see how much it's actually affecting you, and whether you have to ask yourself whether it's worth trying to eliminate the errors as much as possible. If it's costing you 50, 60, 75% of your losses from your trades, well, maybe it's worth being honest with yourself and eliminating your errors, or trying to at least. Some examples of trading errors. First one's FOMO. If you don't know what FOMO stands for, is fear of missing out. This is probably one of the most common errors that, at least for me, probably my most common error that I am a victim of. Often traders will chase the trade. You're looking at a level, for whatever reason you don't get into the trade. Now it starts moving and you're like, well, I need to wait for a pullback. Well, it never pulls back, it keeps going, and you can't stand it anymore. You enter the trade only to buy the top or selling the bottom, and the trade pulls back to originally where you would have gotten in, and it stops you out because you're trying to follow your risk management, and the trade goes in the direction that you intended it to. So it's very frustrating, but it is a trading error. It requires a lot of discipline to overcome this one, but you do need to track this, and you do need to track the cost. Next, another example, moving your stop. This is classic as well. You get into a trade, and you start coming up with different reasons or telling yourself why you should move the stop. Well, hey, VWAP's right here, I can move it below VWAP, use that as protection. Or hey, there was a better level here. Oh, the stops are obvious here, so I don't want to be one of those suckers, so you move the stop lower so you don't get stop run. This is a very classic one, and what ends up happening is over time, instead of getting a loss of, maybe your stop is 12 ticks in ES, and instead of taking a 12 tick stop, you're taking a 20, 30, 40 tick stop. And if you keep doing this over time, your profit factor and your expectancy will drop, and you'll be wondering why your P&L sucks. Next, not executing the trade when your setup shows up. So this is one that could be caused by fear, not fear of missing out, but fear of losing. Often your setup shows up, it's at a level you've been watching all day, price approaches it and starts doing what you thought it would do. Order flow looks good, and you just can't pull the trigger for whatever reason, and now you hesitated and price has moved away from your initial potential entry, and it's working, but now you're wondering to yourself, should I chase this? Should I still chase this? Well, you missed it, brother. It's definitely hard to take these, and you need to track this error and see what the cost would be of your missed trades. Taking a trade that's not your setup. This is, well, I guess the opposite of the prior one. You've been waiting along all day, and none of your setups show up. Maybe the market's not moving much, and you get bored, and you just take a trade and start telling yourself reasons why you should, hey, this looks good, or the market just has a little blip or increase in volume, and you think it's the market's going to move some more, and it's not your setup, but you still take it, and you look back and sometimes you ask yourself, what kind of trade setup was that, and that's a pretty big error as well. And I think all of these you need to track, and really you need to be honest with yourself, otherwise you're not going to do yourself any favors if you're not honest with yourself, and you're just ignoring the fact that you're brushing your errors under the rug, so to speak, and you're not really understanding how much it's costing you. So yeah, there's more errors. I think different traders have different issues, but these are some examples of errors that I think are pretty common for most traders. All right, trading edge. What is a trading edge to you? So a lot of people define trading edge differently. Some may talk about it in a probability standpoint, the probability of an outcome or a positive outcome occurring more often than a negative outcome. Some might describe the trading edge as the results of your or having positive results of your trading strategy or the way you trade. So I think It's a combination of both. You kind of want to, to me, an edge is basically the positive results of your trading strategy or how you trade. Um, Obviously, if you don't have an edge, then what you're doing is not working. It's not producing a positive result, meaning that your strategy or the way you trade doesn't have the edge. The probability of an outcome occurring over a significant sample size, well, the edge can come and go. So it can appear and disappear, meaning that maybe during certain market volatility, your edge shows up more than when there's no volatility. So it's really, when it comes down to it, you really need a way to measure your edge. And how do you do that? Well, you can use your expectancy and your profit factor and your win rate, like different statistics, to understand whether what you're doing or your strategy or how you look at the market is producing a positive result, equating to a trading edge. So if you don't measure any of those things, then how do you know that your what you're doing has an edge or not? And if you don't have an edge, why are you trading? Good question, right? Okay, rounding out the last question here. Do you have a well-defined trading plan? Not having a trading plan is like taking a flight with no flight plan. So if you don't have a trading plan, it's like you don't have a compass or a direction or a goal of what you're doing with your trading. Um, a long time ago, like I didn't really have a trading plan written down as well. Yeah, I had something in my head where I knew what I was doing uh, in my head, but I never wrote it down. And I found that after I really created a robust trading plan, it really kind of solidified what I need to do and how I can measure myself against my trading plan, maybe month to month, and understand like whether you're on track or not. Because it's so easy to change what you do and what you say you're gonna do if you don't write it down. Oh, in my head, I'm just 1 month I'm gonna do things this way. I'm gonna make an adjustment and then do things differently this way. But if you don't have a track record of that or the trading plan written down, then how do you go back and measure whether you followed what you said you were supposed to do? And that's probably one of the biggest problems that people or traders face. It's like you think one way, but you don't really follow what you say you're going to do, and that's a big issue. What are your trading goals and why do you trade? Like writing these things down, like if you don't know why you trade, like is it for the rush? Like do you get a high from making money, losing money, punishing yourself? Like trading is not easy, and if you are just looking for a high of that rush, then why don't you just go to the casino and play slots, right? I mean, that's maybe gonna give you the same dopamine feeling, but why do you need to risk hundreds or thousands of dollars in trading when you can play penny slots? I mean, if that's all you're looking for. What markets do you trade? Understanding, like focusing in on certain markets, like maybe one to two to start with, maybe you have 3 down the road, but being an expert, being a master at a couple markets is probably like all you really need. I mean, if you're day trading, swing trading is different because if you're trading different stocks or bigger time frames, then you have a little bit more time to really assess. You can let things play out, or you don't need to make things happen or adjust anything within the same day. But if you are day trading, like I really would recommend like identifying what markets you actually trade, and then becoming a real big expert on like understanding like everything about those markets. Like if you're trading futures, is it a cash settlement? Is it a real settlement, like if you're trading crude oil, like if it's, you know, contracts settle and, you know, you're actually going to get delivery of crude oil, like these things like nobody really thinks about. Is boring. What time is RTH session? You know, these things like you need to understand and be an expert at it. And if you don't know or have a certain market that you trade and you're all over the place, so one day I'm trading crude, next day I'm trading copper, another day I'm trading ES or NASDAQ, it's like, well, they trade differently too, so you don't really get a chance to really familiarize and be an expert at any one market. What is your process prior to any trade is taken or when you exit the trade? So like what do you look at? Like what kind of prep do you do, or if you do any prep, or do you need to do any prep? These things need to be outlined and figured out before you take a trade. You should have a process of different criteria you're looking. What is your setup? And not only like when you, it's not only for when you know, prior to taking a trade, but how do you exit trades? Like, do you scale out? Like, where do you look for? Like, what's your method of getting in and getting out? What's your risk management rules are? We went over this in the previous slides. You really need to understand that risk is a big factor in your trading success, because you are going to take losing trades. Like, no one's 100% win rate trader. So if you don't manage your risk properly, then you're going to struggle quite a bit. And rules around the risk management means like say for example, if you have 3 losers in a row, like, are you going to stop or are you going to continue? Do you have a max loss per day? Because it's so easy for you to just take trade after trade and lose, and you're not even aware of the smoke alarms going off, and you're sitting in a house that's on fire, and you blow up your account, right? So very important to understand what the rules around your risk management are. Lastly, what is your process when you start losing your edge? So this comes back to measuring like your edge, right? We talked about this in a previous slide where, well, what happens? Like, let's just say your expectancy starts dropping and it's below 0. Well, are you going to continue trading? Like, you know, if your expectancy is below 0 and your profit factor is below 1, you're, over the long run, you're going to be losing money. So what happens when you start losing your edge and there is no edge showing up? Do you go back to sim? Do you stop trading? Do you reassess? Like, what's your process of getting out of the rut? Because trust me, there's going to be times where you're going to have loser after loser. No one's perfect again, and no one's think you're Soros or like Ray Dalio or any of those big legendary hedge fund traders. Like, no one's like that, right? I mean, even they have losers, right? So it's like, well, what are you going to do when you start losing your edge, or the market changes and your edge starts disappearing? Like, do you continue just losing money? Maybe not the smartest thing, right? So you need to have a process around what to do with that. So in conclusion, what is the common theme here? Track and measure your trades. You really need to do that. If you don't, how do you expect to improve? What do you even improve on? The problem is that if you don't measure yourself, you don't know where you're going wrong, and you don't know what areas of trading need improvement and what doesn't, right? I think in all the questions that I've asked, if you don't track or measure your trades, then it's really hard to answer those questions. Again, these are just a few points I think that can help a trader improve drastically. Like, right now, you need to start tracking your trades, and not just like tracking like entry, exit, P&L, date. Like, that's given, but you really need to track and start tracking those things, yes, but you also need to track, like, hey, where's your targets, how far trades went, and calculating out your expectancy and profit factors. So those can kind of give you a better compass and guide to understand whether you're on the right track or if you're trending in a proper direction. Otherwise, it's going to be very difficult for you to understand what you need to improve on and how to improve. So I thank you for watching all the way to the end. I hope everyone found some value in this short little, I don't want to call it a webinar, but kind of educational or kind of tips and things I found that helped me be a little bit more successful in my trading, and kind of give you a guide of what measurements and what factors to look at when you want to improve, and really understand like how you can create a better a plan or progression in your trading. So thanks again for watching. Hope you find value in it. Talk to you guys later.